Right, traders, so in this video we're going to be diving into the art of choosing supply zones and forming wicks to your advantage, right? So what do I mean by that? So we're going to be understanding exactly what a supply zone is, how you can find a wick, and how you can trade bearish setups. So this is going to be all about bearish setups, right? So we, in this video, are going to be going over the following concepts, right? I want traders to understand how to form a supply zone, how to use the PO3 to your advantage, and also how to use order flow at fair value gap. So these are the three things that we are going to cover. So we're going to be going over a sell trade I took on Wednesday the 9th of July in the AM New York session. So this is the 15-minute time frame on ES or the S&P 500. So how am I marking out this chart? So I always start off with basic market structure. So what we had is we had a structural low and we had a structural high. So this was the dealing range going into Wednesday. So I'm just going to replay price and I'm just going to go to Wednesday. So this was Wednesday. So what we can see straight away is that we have, of course, our 50% area. Anything above the 50% area is a premium, right? So we're in the premium. And it's very simple how this trade was panned out. We have a 15-minute fair value gap, right? So this is my POI. It's very simple how I form this, right? So this is my POI, and I'm just going to label this in gray. So this is my key level, my POI, my point of interest. It is an area on the charts that I want to trade from. And so why did I pick this area? Well, there's a couple of reasons, right? So we had a minor breaker structure down here. We broke structure over here. And more importantly, if I just bring on the Asian range, right, we can see that the market manipulated around the Asian range. So we can see a phase one manipulation. I call this a phase one manipulation because price has taken out the price has taken out the Asian low. And then of course here, price has taken out the Asian high. So what we're seeing is we're seeing a double phase manipulation. Price has taken out the Asian low, then the Asian high. So this is my point of interest. And it's really that simple, right? We have a breaker structure, we have a liquidity sweep, and we have a fair value gap. So I'm just going to mark this out. So what makes a point of interest, right? What makes a point of interest? We need a fair value gap. We need to be ideally in the premium for a bearish fair value gap. And we need to have some kind of a liquidity sweep, right? So this is the formula, right? This is the recipe that I'm using. I want to see a fair value gap, I want to see a premium, and I want to see a liquidity sweep, right? Not necessarily in this order, but this is what I'm looking for. So when price does come into this POI, it's very interesting when we understand what was going on in price. So this was now Wednesday the 9th. This POI was formed on Monday. So I got a question today, do I keep my POIs on the charts? Absolutely, yes, I do. And the reason for that is, especially if they're unmitigated, the markets can come back 1, 2, 3, 4, even a week later, re-mitigate that unmitigated level and give us fantastic trade setups. So I'm always looking to leave my levels on the charts, whether they're mitigated or especially when they're unmitigated. So this is my POI. So just to give traders a framework of what we're looking at, we have bullish market structure. We can see a bullish structure, right? New high, all-time high. We're in the premium. So when we're in a premium, we naturally want to be looking for shorts if we get our entry criteria. So here we are on the 15-minute time frame. So if we just take a look at this 15-minute time frame over here, what we can see is price has rallied up heavily, aggressively bullish, right? So let me just put on another indicator for traders, right? This is the daily PO3. So how does a daily candle form? And this is what I want traders to understand, right? What constitutes to an A+ setup? So an A+ setup is one that comes from a key level, right? So we've identified how to find a key level, right? If there's no level, there's no trade, right? Traders can miss out on a lot of losses, right? And hence take a lot less losses if they simply waited for price to hit a key level or a POI, a point of interest. So we want to see a key level. We want to see a PO3 alignment. So what do we mean by a PO3 alignment? This is a power of 3 alignment. So when you're trading, right, when price comes into a key level, right, you want to be selling when you're above a candle's opening price, right? I usually use the 4-hour candle's opening price at 10 a.m. Eastern, or I use the daily candle's opening price. So this is the price at New York midnight opening price. And so how does any candle form, right? Typically the daily or the 4-hour candle, right? So we're looking at higher time frame analysis, right? This is classic higher time frame analysis, right? A lot of traders, they try to use a daily, they pair it with the 4-hour. That's usually the incorrect way to do it. The best way to do it is to use ICT's simple concept of the PO3 and combine that with order flow at key levels, right? It's really that simple. And that is the third thing we look at. We look for a key level, we look for power of 3, and then we look for order flow. These are the 3 steps to any trade setup, trading supply and demand, right? So the only way you know that this is going to be a supply area and this is going to hold is simply because of the order flow. And we're going to come on to order flow in this video, as you can probably guess. But just by looking at the PO3, right, the market opens, right, the market goes down, then the market goes up. Now we are looking for a form of resistance or a form of supply. I'm just going to write R or S, right? Resistance or supply. And so this resistance or supply will best hold when we're significantly overextended above the daily opening price. So this is the daily opening price, and this is where we're looking for trades, right? We want to be forming our sells, we want to be forming our supply zones significantly above a candle's opening price, right? This is ICT Basics 101. So with that being said, we're going to go down to the lower time frames and understand what was going on. So we're going to look at it now in terms of what we can see, but I just want to draw traders' attention to one thing, right? Look at this candle over here. So if I just draw out one more candle here to the right over here, what was going on inside of this region, right? So when price fails to break above a key level or a POI, what does that tell you, right? Most traders gloss past this, but this wick is interesting, right? This wick is interesting. So why am I interested in wicks, right? Interesting. If price fails to break above the level, what's really happening from a very technical perspective is we are seeing aggressive, I'm just going to write AGG, we are seeing aggressive buyers fail. We're seeing aggressive buyers fail, which means that passive sellers are in control, right? When passive sellers are in control, these are responsible for driving price lower, and this is what we're going to go over in this video. So if we just head down to the 1 minute time frame, if we just go down to the 1 minute time frame now, so on the 1 minute time frame, what was going on? So we want to be studying what was going on in this yellow box, right? Because this yellow box is essentially why I took the trade. So if we just go over to the Discord and see how I was playing this live, give it a second to load. So here we are. So that day we obviously make a pre-market game plan. I always look to plan my trades 10 to 15 minutes before market opens. So that's 9:30 a.m. EST in New York. So that's going to be 2:30 p.m. here in the UK. So ES, S&P 500, right? So study here, right? How price is behaving near the weekly opening price. So this is the weekly candle over here. If I just dive in, right? So this is the weekly candle over here. So notice how, again, this is the same POI. We're above the daily opening price and we're above the weekly opening price. So for those who trade any kind of ICT concept, you understand that the best sells will come above the candle's opening price, right? This is very important to pair with fair value gaps in order flow. So we're well extended, right? So when price comes to here, we're going to be extended above, way above the daily opening price, and we're also above the weekly opening price. So that's the POI I'm looking for. Also, to give you some higher time frame context, we did tap into this higher time frame, demand area. We tapped into this fair value gap. We respected it with a wick, and then we're heading higher, right? So we're seeing bullish order flow. So this shows you an example of taking a counter trend trade when you have PO3 and order flow aligned. So that's what we're going to be going over in this video, right? So here we're going to be breaking this down. So if we just take a look at what was going on here, right? So this is the same POI. If I get them up side by side, this is the same POI that you see over here. So this yellow box is what we're going to be studying, right? This yellow box is what we're going to be studying. So it's interesting that aggressive buyers are failing. So this is how a supply area forms. A supply area forms when aggressive buyers fail. So we want to understand what was going on in this candle, right? So let's just quickly study this in a lot more detail, right? So what was going on, right? And I want traders to read the order flow with me. So what we can see is we can see 0 for 48, right? We can see over here, we can see the delta outliers. Delta outliers are simply regions shaded that are blue. So what does a blue delta actually mean, right? A blue delta, very self-explanatory. The ATAS platform, this is the ATAS platform, ATAS. It allows you to read the aggressive sellers versus the aggressive buyers in real time. So what we can see, if we just kind of analyze this, right? Let's analyze 462 for 724. So 462 market participants hitting the bid. These represent aggressive sellers, right? The left number are sellers, aggressive sellers. They're going in with market orders. They're hitting the bid live. They're hitting the markets live. Now, if you look at 724, that number is a lot higher than 462, obviously. So that is why we have more aggressive sellers and aggressive buyers. So if we go back to the candlestick chart over here, what we can see is we can see entering the zone just over here. Entering the zone, we had a lot of aggressive buyers. So where I've circled over here, we have a lot of aggressive buyers. And so that is what we see just over here. So we see a lot of aggressive buyers. So these aggressive buyers come in heavily into the zone. Now we want to focus on this wick over here. So on the 1 minute time frame, of course, we saw candles closing, but on the 15-minute time frame and also the 5-minute time frame, there was a wick above, then the market's headed lower. So what is going on inside of a wick? So this is the main kind of topic of today. It's a case study that's going to be breaking down the power of a 15-minute wick. So if you can understand the power of a 15-minute wick, you will be on the right side of the market 80-90% of the time. So what was going on inside of these candles? Again, this is the 5-minute chart, right? So what was going on? It's very simple. Let's kind of take a deep dive in, right? So what was going on? 718 for 1K. So what does that mean? There were 1,000 aggressive buyers and there was only 718 aggressive sellers, right? Look at the very top. There was 115 aggressive buyers and there were no aggressive sellers, right? So the bid is 0. The ask is 115, and just down here we see 718 for 1K. So we're seeing aggressive buyers over here and we're seeing aggressive buyers over here, right? So let me ask you a question. If we see so many aggressive buyers over here and so many aggressive buyers over here, likewise we also saw so many aggressive buyers over here. Now this is the candle that starts to give it away that we're at a true area of supply, right? We're at a true area of supply. And the reason I know that, even without reading the numbers, is simply because we had a huge amount of positive delta, right? Positive delta represents the fact that the markets are hitting the ask. There's more ask participants that are trying to drive price higher. But if you just kind of play price on, even on the candlestick chart, what happened is we saw price breaking lower. In fact, we see that just over here. So we saw price breaking lower. Ooh, a little bit too far. So what we saw is we saw the markets breaking lower, right? So we see an official body break over here, and that corresponds, this body break corresponds to what you see just over here on the 5-minute chart. So on the 5-minute chart, we can read these numbers. I just want traders to understand. We saw 75 for 233, right? We also saw 0 for 115. Right? So we are seeing a large ask volume, but these aggressive buyers have not been rewarded, right? These aggressive buyers have not been rewarded, because if these aggressive buyers were being rewarded, they would have broken price above this level, right? So this level held, and the reason the level held is because we can see aggressive buyers have failed, right? So these regions over here that I'm circling, just over here, and then of course we break below over here. So these aggressive buyers have failed. So when aggressive buyers fail, this means that sellers are in control. So let's just kind of play price on again, right? So we see buyers coming in, we see that wick below, and then we see this. So we're focusing on these areas here and these areas over here. So what this means, right, very simply put, I want to make this as simple as possible for traders. We're looking for an entry and we're looking for aggressive buyers to fail, right? So we're looking for aggressive buyers and we're looking for a break to the downside. We're looking for a break to the downside. So why are we looking for a break to the downside? Well, the reason we're looking for a break to the downside is because we need to see aggressive buyers failing. And that is the that is the science of a fair value gap, right? So fair value gaps should be treated as a science, not as an art, right? So at least I see a lot of traders treating it as an art. So what I mean by that is, if I just kind of draw some nonsense over here, what they'll look for is they'll look for a liquidity sweep, and then they'll look for an I fair value gap, and then they'll try and key off the I fair value gap, or they'll look for a 2022 model with a market structure shift, then they'll key off a fair value gap, or they will look for my favorite, which is they'll look for like a moon cycle. Well, I'm joking about that one, but you get my point, right? So you're not going to be, you can't trade price without reading price. I know it sounds a bit, controversial, but it's not. You can't trade price without reading price, right? So there's no pattern, no indicator, no EMA, no ICT model that's going to help you here, right? So the 2022 model didn't even play out here. So a lot of traders would have missed the trade, right? But what was going on over here? Aggressive buyers failed. We saw a very, very clear, heavy absorption of buyers, right? So if I just kind of make this screen a little bit bigger, I want traders to understand what was going on. Sorry. So what we can see is we can see price entering, and we're seeing right off the bat blue delta, and we see a break below. That break below shows you that no pattern is going to come and save you. You got to understand the fact that aggressive buyers have failed. Now, when aggressive buyers have failed, your job is to simply understand that, read that, and then target the next fair value gap below. So that's what I'm saying. I'm saying price could come here, and then this is of course the execution. So I went in with 9 contracts of MES, stop loss just above the finished auction. And again, if this was the entry over here, what was going on over here, right? We see 107 for 265. We see the same thing, right? We see a red candle, but we see more buyers towards the top, and then we see a melt off. So this melt off was predicted because of 3 things, right? This melt off was predicted because of 3 things. So if we just go back to the regular chart, there are 3 things that allowed you to predict the melt off, right? We had a 15-minute fair value gap. So we had a key level, right? We had a key level. That's important. Then after we had a key level, we were way above the daily opening price. So what we had is we had PO3 alignment. Then of course we saw aggressive buyers fail. So these aggressive buyers failing means that passive sellers are present, right? So it's showing you passive sellers are present, which means that sellers are in control. It's really that simple. So if you're struggling with psychology, I want you to kind of, ditch the patterns, right? And ditch the indicators, and even ditch EMAs or whatever you're using, volume profiles at the bottom, right? I just want you to focus on reading the numbers. Reading the numbers, not even reading the numbers, reading the colors. Right, read the colors and ask yourself what's going on, right? Aggressive buyers are failing, right? Blue delta, blue delta, blue delta, right? All those sellers are trapped. We call them trapped, we call them absorbed. They're exhausted when price breaks above the level, right? We had massive exhaustion of buyers, which means there's a huge supply over here. So this shows you that this fair value gap is a strong fair value gap to be trading from. Right, so of course then we target over here, profit just under $465 for the day, right? There were further opportunities at this key level, right? We saw absorption of buyers again, absorption of buyers again. So we're seeing the markets follow through at 15-minute fair value gaps, right? So the entire entry model is based off 15-minute fair value gaps, right? So if we just kind of clear the charts up a little bit, right? Where would I enter myself, right? So what I'm looking to do is I personally like to enter when we see a solid break below the zone, right? So I would probably want to enter here. And I would be comfortable having my stop loss just below this wick over here, right? I think this is a bit too tight. I would like to have it here. And that gives me plenty of breathing room, right? You don't need to have a super tight stop loss. The reason for that is because the market has our next fair value gap down in this region, right? So this was the next fair value gap price went and hit. So you're simply trading from one fair value gap to the next, right? It's really that simple. Right, so if you're trading fair value gaps and you're struggling with psychology, with strategy, with technicals, whatever it is, right, I want you to just kind of understand that no pattern is going to come and save you, unfortunately, right? So you're not trading patterns, right? No patterns, no ICT model, right? No ICT model, right? No indicator, right? I'm not using any indicators. The ATAS platform is what I use. It's not an indicator. No patterns, no indicators. Also, no psychology is going to save you, right? This is very important. I want traders to understand no psychology is going to save you, right? No mentor is going to save you either. No mentor is really going to save you. If you're trying to trade price, you need to read price, right? This is price, right? This here is price. If you want to trade price, it's important for you to read price, because if you can read price, you can know what's going on, and if you know what's going on, you have a higher chance of making it. So if you want to trade price, you need to read price.